Welcome back to FT Markets. Take a look at European stocks and you'd think spring had arrived early. Eurozone share prices are up 10% already this year. So what's making Europe bloom? With me to discuss this is Andrew Parry, who's head of equities at Hermes Investment Management. Andrew, welcome to the Financial Times.
Thank you.
When we look at European shares and the performance so far this year, obvious question, isn't it just QE by the European Central Bank?
Well, it's undoubtedly, an important factor, and given, the scepticism that is prevalent about European equities for good reason from the last 5 years of disappointments, we're coming from a low base. And I think, though, before even QE started, we were beginning to see some signs of life in European equities.
Before we move on to those signs of life, let's just look at the chart you brought along showing precisely you call it the policy arbitrage. This is, perhaps you just very quickly explain the chart. It shows Fed against the ECB.
Yeah, well, there's two lines on here. The blue line shows the performance of the stock 600 in Europe versus the S&P 500. Pretty dismal tale over the last 15 years.
America doing much better.
Yes, and then the red line shows the relative size of the ECB versus the Fed's balance sheet.
The ECB shrinking whilst the Fed expands.
Yes, and that's what people forget.
Recently.
Yes, in 2011, the ECB actually tightened monetary policy by shrinking its balance sheet. The Fed have had their foot to the metal in this period. However, with tapering that happened in October, we've seen a very marked shift in this dynamic. And looking forward, the Fed will be, at the very least, holding its balance sheet flat and could even move into reducing it as the year progresses, while the ECB is expanding its balance sheet.
Which we start to see that outperformance in Eurozone stocks at the end there. You think that has some way to go then?
Well, there used to be the old phrase, don't fight the Fed, and now it's don't fight Mario Draghi. And I think undoubtedly for asset prices, central bank balance sheets and policy action has a very big influence. Now we can debate whether that has such a big influence on the economy, but when you're actually printing money, you do actually boost the value of assets.
Let's talk about the positive factors then we'll come to the negative afterwards, but the positive factors besides QE supporting stocks. You mentioned at the beginning.
Yes, well, of course, we've seen the reversal in some of the headwinds. The euro back in June was, 140? Now it's 114 against the dollar. It's undoubtedly providing a competitive advantage to the exporting companies in Europe. We've seen the collapse in the oil price, and Europe is a big oil consumer. That is undoubtedly going to have a benefit too. We've also seen the TLTRO,
credit easing
back in the summer.
Yeah,
that's finally beginning to see credit conditions ease, credit demand begin to pick up in Europe, a little bit like funding for lending in the UK. Remember, there was scepticism when that came in, but that has actually begun to have a compounding positive impact in the UK.
If we look at our second chart you brought along, it's a little bit complicated, but basically this is showing expectations for earnings, European earnings, at various points. And basically, if you look at the expectations for, as I understand it, the red line shows expectations for 2014, blue line expectations for 2015. And what we see is that right at the beginning of this year, expectations for last year's performance suddenly picked up, but still scepticism about 2015, 2016.
Yeah, a lot of scepticism. And in fact, if we'd actually included the previous forecast for 2010, 11, 12 and 13, you would have seen these downward sloping lines all the time.
Yeah.
So the markets have been conditioned to expect disappointment from European corporate profits. The reason we show this is that by the end of the year, last year, it was the first time in nearly 5 years that we've seen positive earnings surprises coming through for the corporate sector. But that scepticism now that the market has that can't be repeated into this year and into next year is actually an opportunity, because Europe's always needed growth to deliver on its potential.
Okay, but let's talk about things that could go wrong. We've gone almost 4 minutes without talking about Greece. That has to be a big worry.
Yes, well, Greece is doing its own version of Game of Thrones at the moment, with this very intense negotiation to see who can blink first. That is definitely a tail risk. If Greece does explode from the euro, then that is a risk that will cause severe problems in Europe. But we can't invest on tail risk. We have to focus on what's in front of us. So yes, we are sort of nervous about that, but we do believe a compromise will be reached.
And what else? What, do you believe that growth will return to Europe, or could it just be a flash in the pan, or are there other big worries that we should mention?
Well, remember, we're coming from a very low base of expectations, and even as relative optimists at this point in time about Europe, we're not talking about a boom, we're just talking about a moderate improvement in conditions. But it's the second derivative that drives markets and expectations. And for once, that's actually turning positive. Spain's got good growth, Germany continues to power ahead, even Portugal and Ireland are doing well. It's an uneven recovery in Europe, but it was always going to be. But there are enough positives now to think that maybe Europe for 2015 at least could fulfill its potential.
Okay, Andrew, we're going to have to stop there. Thank you very much. So some signs of life in Europe, but from a very low base, and caution and scepticism still prevalent in markets.